Thank you for tuning in to the San Antonio Express News Tax Guide panel discussion. This panel is intended to provide helpful information to local businesses and individuals looking to be informed about their tax needs. The discussion is moderated by San Antonio Express News business columnist for SA Inc., Michael Taylor. Panel participants include Cindy Montoya, president at KAC Consulting, Donnie Lawrence Jr., the managing director at Stone Oak Wealth Management, and Dustin Wittenberg, attorney at the law offices of Dustin Wittenberg.
Thank you, everyone, for being here. I want to start with Cindy Montoya of KAC Consulting. You work with small businesses, both for tax preparation and end-of-year tax planning, and also planning throughout the year. We are recording this, we're having this conversation in January of 2022, the start of the new year. And what do you wish you could tell your clients to start the year out right?
January is a good time to focus on better bookkeeping. Know your numbers on a regular and consistent basis. Your numbers or your KPIs, key performance indicators, they're like the gauges on your automobile. They indicate when there's a problem or when things are running smoothly. So based on your numbers, you can make small changes in your business throughout the year that'll reap huge rewards over time.
So what's something which, if your clients did at the end of the year, would not go as well as if they followed your advice and they started out right from the beginning, keeping the records, keeping their KPIs?
Oh, I have so many stories about things that need to be done on a regular basis. One big issue right now is payroll, independent contractor versus employee. And I'm sure Dustin can speak to this issue as well. But one example is a small business owner paying their minor child to work in the business. Well, that's a great planning tool if it's done correctly. But if you paid your child throughout the year and you don't include those wages on your quarterly payroll reports, then come year end, you have an issue. And it's going to be difficult and it's going to be expensive to fix. And no, don't give your child a 1099.
So then your business, at the end of the year, if they come to you with that problem, you're going to say, we're going to have to work backwards to make this right. An expensive solution to what could have been a simple setup at the beginning of the year. Donnie Lawrence from Stone Oak Wealth Management, I want to turn to you and build on what Cindy has said. Yes. Your firm sometimes gets involved when a business owner has either built up sufficient wealth or is considering a sale or liquidation event. My sense is that there are some steps that people should be taking in advance of that. What are you advising them tax-wise when approaching this kind of big step?
Well, Michael, first of all, thank you for having me on this panel. It's an honor to be able to speak to your guests and so forth. The biggest thing, and the old adage is, measure twice and cut once. Planning. Usually when these big transactions come, there's a year, maybe 2 years, or 6 months that you have time to go through and dot your I's and cross the T's and consult with your financial planner, your accountant, your estate attorney, because depending on what they want to do, there are some ways to make sure you take advantage or you use all the appropriate tax laws to give value, all the hard value that you built up in your business, to get that out to you or to your children, or maybe you want to be philanthropic and gift to charity. And so there's ways to do that, but the best thing to do is to start to plan and have many discussions with all your advisors and making sure they're all on the same page.
It sounds like Cindy said, early planning is the most important thing. You're referencing not the month of the transaction, but 6 months earlier, a year earlier, maybe more than a year earlier for planning. That's kind of the key here.
Yeah, really it's when the thought comes up, or a lot of folks who are business owners, they're thinking, I've been doing this for 20, 25, 30 years. I'm about ready to back out. That's a time to start thinking, okay, maybe we should look at it. What's the best way to back out of this? Or when they're approached by a potential buyer, to start, crunching the numbers and see what they look like, because there's an asking price and there's a net. And so if that net is not the number that the business owner or the folks who are selling it are looking for, then maybe they keep going. Or like I said earlier, there's generational businesses and families want to keep the business in the family. What's the best technique, the best way to educate generation 2 and what generation 1 has done? And then once again, it involves planning, discussions, sessions with all their advisors to make sure everybody's on the same page and to be as efficient as possible.
So one of the things I'm hearing, this is coming and you're assembling a larger group of people who are going to be addressing the client from lots of different angles.
You bet. It's kind of like on a team, a basketball team. There's not just one person who's scoring all the points and playing on defense. There's 5 of them. And so you put those 5 people in the best position to take care of the client. The client's in the center. We work around. We all have different expertise. What my firm does is we kind of coach all that through there and help the clients walk through that process. Making sure everybody is on the communicating and on the same page and walking them through that process. So it's definitely a team effort.
Thank you. I want to turn to Dustin Wittenberg, law offices of Dustin Wittenberg, and you are a tax specialist and attorney. Sounds like you might be the kind of person who's a member of the team bringing in special expertise. I wanted to ask you to respond to both Cindy and Donnie are talking about planning in advance. And on the other hand, I'm suspecting that sometimes clients are coming to you after the difficult trouble has already begun. Do I have that right?
You're correct. Many times I get contacted after a problem has arisen in a small business or with an entrepreneur because they don't necessarily know to start planning the transaction a year ahead of time or 6 months ahead of time, or they do things in their business like hire the child and try to send them a 1099. And what I'd like to tell everybody is when you have a tax problem come up, the Internal Revenue Service generally sends you lots of letters, and occasionally they'll come visit in person, but they're not sending you emails or calling.
And you're referencing that. Is that because sometimes people are impersonating the IRS through a phone call? Is that what that's about?
That's right. We've seen a lot of phishing scams and a lot of those things pop up over the past few years. And so every time you start the conversation of somebody believes they're in trouble with the IRS, you want to make sure they're getting that notification in the right way.
So if you're a business owner like Cindy may be working with, or Donnie may be working with, and you want to make sure you never get afoul of the IRS, what kinds of questions are they bringing to you? What kinds of advice are you giving up front before the problem happens?
So right now, already in this conversation, it's been referenced that employee versus contractor, that's becoming a big issue. I'm seeing lots of employment tax audits, and the key there is control. So Cindy was right. If you have your child working in your business, don't send them a 1099 because your child is clearly under your control. You're clearly telling them what to do and how to do it. Other things that I've been seeing are matching issues with information returns. People forget a 1099 here, a W-2 there. And also, it seems like a lot of people effectuate rollovers between tax deferred accounts, like from an IRA to another IRA or 401k to an IRA. And the important thing they need to know there is never take possession of the funds. Mm-hmm. Don't pick up a check. Don't cash a check. Don't take the funds into your account. Make sure that the transfer is between administrators. And when you sell a house, there are lots of provisions about not recognizing the income from the sale of a house. You still have to disclose it, right? It's not I sold my house, I'm not going to disclose it on my tax return. That leads to lots of problems. And really in the pandemic, what you've seen is a lot of issues that would get cleared out in administrative communications or initial letters. That's not happening, and they're getting upgraded and prioritized in ways that they never would have before. And so I will tell people, if you start getting letters from the IRS, take them seriously and get to somebody who knows what they're looking at.
It sounds like one big picture piece of advice is if you hear from the IRS, don't sit on it. Turn to somebody who's an expert in this issue. You mentioned about 4 different common problems it sounds like you're dealing with. I wanted to dig in with one of them that Cindy had actually mentioned and maybe have you both address it. Can you just explain to me the type of business that's going to have an independent contractor versus an employee problem, and then why business owners are choosing one or the other, and then how they're doing it potentially wrong. And I'd actually ask both of you to talk about that, just to spell it out for me a little bit more. What type of business is doing this? Why? And then how are we doing it wrong?
Well, so the three businesses I see most often in this situation are construction and trades, right? Building companies, contractors with pick your project, truck drivers, and surprisingly, people in the nail and hair and beauty areas like barbers, hairstylists, nail people. The reason the employer prefers to do that is it gets them away from their obligations with regard to withholding and paying over federal income tax, which comes with a lot of liabilities and a lot of risks for the employer. The or the independent contractor would prefer to receive a 1099 because they get to deduct any of their or offset any of their expenses above the line for the generation of that income. And what the issue is one of control. So it gets down to who provides the tools and who dictates the terms of the employment or of the project. And it all is about avoiding withholding obligations and requirements. And Cindy, please pipe in whenever you would like to.
No, that pretty much covers the subject. One thing I would add to that is you can run into issues not only with the IRS, but also with the state of Texas. We've been through several audits, payroll audits with the Texas Workforce Commission.
Dustin, you mentioned another issue, which has to do with defined contribution plans in which folks are rolling over. And Donnie, I don't know if you're also dealing with that with your high net worth or business owners where they have significant savings built up inside of a retirement account.
Yes.
Can you address that issue of making sure we clarify what that means, that we don't, that we roll this over properly, or we're dealing with those assets?
The easiest thing to do is when you do roll over the asset from a retirement plan to an IRA, or from a retirement plan to another retirement plan, is that, as Dustin said, don't take possession of it. Doesn't mean that you may not receive a check, because sometimes the retirement custodian will mail the check to you and put the onus on the participant to make sure it gets to the IRA or gets to the new retirement plan. It just means that the check is made out to the other custodian, whether if it's Fidelity going to Vanguard or TD Ameritrade going. You just don't want it made out in the participant's name, especially if they're younger than 59 and a half, because there's extra early distribution penalties that can affect you in addition to your ordinary income tax.
I wonder if any of you could address this. I have found that people are unaware of how to do a rollover and believe it's going to be a difficult process to roll over from one former employer into an investment account. And I guess, Donnie, maybe you could address this, or Dustin, I have told people, I think it's true, but that it's actually not hard. What you need to do is go to the destination institution and say, handle everything for me. Here's my account number. Can you go do it? Is that a true thing that I've been telling people, or is it not as simple as that?
It is as simple as that. And where I see people getting in trouble is they lose focus on the rollover and making sure that the rollover occurs within the allotted amount of time. You know, they're changing jobs. Generally, when a rollover is occurring, there are other life changes that take priority to their focus. And it's important that when they're doing a rollover, to be focused on making sure it happens properly and quickly and efficiently. And you're right, the best way to do it is to go to the new financial institution handling the funds and say, please take care of this.
Just to throw something in there, you want to make sure it's done properly, as these gentlemen have expressed, because you don't want to end up in February or March in your tax professional's office and find out that you're going to pay a 10% penalty on that rollover because it was done improperly.
And Michael, I would second what you're saying. It is fairly easy. A lot of these institutions will just take a phone call and they'll ask you where to send the check or whom to make the check out to once the account is set up at the receiving firm. And so it's not nearly as daunting as people think. A lot of times when you ask for the form to roll over an account, a retirement account, it's a boilerplate document. And so it may be 6 or 7 different pages, but there's only 1 or 2 sections that needs to be completed. Or as I said earlier, sometimes you can simply call the current custodian and they'll take the information over the phone.
I tell people that the receiving institution really, really wants to manage your money because they can get paid to do that. So they're usually really good at pulling in funds properly without breaching that tax envelope that you're not allowed to breach with respect to retirement accounts. A question for Cindy. I suspect people watching this, what's top of their mind is, how do I save money on taxes immediately for my small business? And I'm wondering, in your estimation, opening up and funding a self-directed retirement account, a retirement account with your small business versus other tax-saving methods, where do you direct people if they're like, I am just eager in 2022 to pay the least amount of taxes for my business?
Well, for businesses, you have the option of setting up a SEP or a simple. One thing we generally do when it comes to that type of planning is we take a group approach. And so then we would refer our clients to someone like Donnie, and we would sit down as a group and figure out what makes the most sense for the employer, for the small business.
Many people watching this in 2022 are eager to save the most money on taxes, especially if you own your small business, you run your own business. Setting up and funding a retirement account is one of the ways. I'm interested to know, is there other low-hanging fruit for saving money on taxes?
Well, I think this goes back to understanding the difference between tax preparation and tax planning. There's all sorts of little tools that we can use for tax planning if we're being proactive. When you see your tax professional in February or March and she's working on your tax preparation, you're looking backward. And there's most likely things that you could have done differently to keep more dollars in your pocket. But by this time, it's too late to change things. So tax planning, on the other hand, is that proactive approach that we've been talking about. So let me give you an example. We had a client come in a couple of years ago, and they owned a successful small business, and they had been, as they should, making their estimated tax payments throughout the year on the schedule that their CPA had set up. The problem is that they hadn't checked in with their CPA all year. And they had, as sometimes happens, a bit of a downturn for a season and a few higher than normal expenses. And so then their taxable income dropped significantly. So it turns out that they had overpaid their estimated taxes throughout the year by $90,000. That's a lot of money to a small business owner. And it put a serious crimp in their cash flow. And now they were having to make business decisions based on that reduced cash flow. Well, do you think they could have made different decisions on employee benefits, for example, or retirement planning, or whether to buy that new piece of equipment to replace their broken down backhoe? All of these things are things that we could have helped with throughout the year. They could have made different decisions based on current numbers.
So that's what you mean by backward-looking tax actions versus forward-looking and sitting down with somebody to look forward and make better decisions.
We don't drive our car while we're looking out the rearview mirror. You're headed for a crash if you do that.
Right. And in this case of your client making quarterly payments, Dustin, correct me if I'm wrong, if we don't make quarterly payments, we suddenly raise the hackles of the IRS, who would say, hey, you're underpaying in that case if you're not making quarterly payments.
Well, in fact, there's a penalty for failure to pay estimated taxes properly. The policy behind it is to effectively mimic the interest that the government loses because you're not paying quarterly. But yeah, it is good practice to pay your estimated taxes quarterly. As a small business, as you get larger, there are more frequent payments that larger businesses get to make. Some even are weekly depositors.
So going along with that thought, yes, we do have to make the estimated quarterly payments, but there's different methods that you can use. So looking back, you can use 100 or 110% of last year's tax based on those rules, or you can make sure that you get in 90% paid of this year's tax paid in. So when we have a downturn in business, if we're paying attention, we can do those calculations and still meet our tax obligations on the quarterly payments.
Donnie, I wanted to ask you, ideally, in your scenario, you're helping clients work through the biggest transaction of their life, the biggest transition if you're selling or liquidating your business. Can you give me an example of a situation where measuring twice and cutting once has saved your clients a ton of money?
Yes, we've had several clients who've come and basically they just went through the transaction and didn't think about, maybe I want to put money to charities. I want to be set up an account where I can keep the money on the side to give when I want to. They've saved anywhere from $3 to $4 million, and that's a significant amount of money, and it's life changing. And they didn't necessarily want to gift it all right now, but we were able to park some of it over here on the side in a trust or a charitable gift fund that they were able to control and manage for their benefit, and also teach their children or the next generation how to control, manage, but also helping get involved in the community. And what we have found is that they were still able to net more money for themselves, but really impact lives, impact folks that don't really necessarily have a lot or need help in such a way that they were helping them. But when it was all said and done, the business owner or the seller was impacted the most because of getting involved in the community. And that's really what excites me, is when you can take wealth and you can multiply and have a domino effect and do good things in the community, as opposed to just striking a tax bill and paying it to the government and letting them do what they do with it.
It is an exciting, optimistic thought to think that we can, through careful planning, save a few $1 million, both to do well and to do good for our families. Dustin, I wondered if you could address working with folks for whom there's quite a bit of money, in intergenerational wealth money at stake. Do you work with high net worth individuals to make sure that the taxes are done right and the planning is done right and entity creation is done right?
I have done that in the past. Generally, in those situations, I generally get hired when an issue arises. I do some planning work, but what I have seen since the lifetime exemption per individual has risen north of $10 million, and it's portable between spouses. To find a couple that's worth $20 million net, they fit in the proverbial phone booth. There just aren't that many people out there with that kind of net worth. But $5 and $10 million, that's still a lot of money. And the issues that I see around there are less about tax planning, because the tax planning around those issues, as long as you know what you're looking at, is manageable. But it's more planning for the beneficiaries or what happens after, because everybody, as you get older in life, develops baggage, right? They have children.
Families are complicated.
Complications. They have children. They have spouses and ex-spouses and significant others that they would like to take care of, and it gets complicated, and it becomes more about family planning than it does, or planning for individuals, than it does about tax planning. And it's just a function of the size of the lifetime exemption. With that said, everyone needs to know that right now, January 2022, is the lowest amount of taxes and interest that you're going to see in your lifetime. Those two things are going up from here. And one of the focuses of the federal government is likely lowering the exemption amount for the estate tax from 10 million to something south of that. And so that is something you should keep your eye on, and you should talk to your advisors about who handle those type of issues.
Right. So to give some historical context, in the year 2000, I think it was $1 million tax exemption on estates being planned, and that was expanded to $4 million, and then recently in 2017 up to between a couple of around $24 million if they combined their exemptions. So there's quite a bit of room to pass on wealth to heirs without having to hit up against a federal estate tax. There's some state-specific rules. But I take your point that the future may not be as generous to passing passing down wealth in that way at the federal level.
That's
Right.
correct. You know, a lot of advisors and a lot of people have taken the tact that it's better to make the gift now with the large exemptions available and deal with lower exemptions later than wait to see what the federal government does. So you do see a lot of lifetime gifts of substantial amounts. And the other thing I'd like to address, you know, I said north of $10 million. You addressed a specific amount. The difference there is that they indexed it for inflation. And so every year there's a change to how big the exemption amount is. And you want to specifically look at that for every client in their particular situation and what their previous gifts have been.
Yeah, and right now, Michael, it will sunset back to where it was in 2017. I think about between 5 and 6 million, with no changing in legislation. The current law will sunset the 11.7 million per person. But what I have found, Dustin, you can correct me, is that the planning that's done in the past is usually grandfathered going forward. If the exemption has come down or something, they'll exempt it. So if you were wanting to put 8 million and gift it to the next generation without an estate tax, and the exemption comes down to 5, well, that 3 million that you're above is exempt from the new legislation, and all the growth is outside. So I agree with Dustin. Planning now is key, and then anything that happens in the future, history will say your grandfather.
You're right about the grandfather on some planning. I just want to focus on a bit of nuance with the word planning. So if you establish a grantor trust or a will right now, and you say in the future, I want to give my children the $8 million, that's not grandfather.
That's correct. Good point.
But if you say today, January 2022, assuming there's no retroactive legislation that happens between here and the end, December 31 of this year, you say, I want to give the $8 million to my kids irrevocably today. That type of planning is grandfathered, and that would include gifts to charitable trusts of various kinds.
Right. And that's what I was referencing. That is correct.
For my part, I wish that I had a problem like this with estate planning. I think that's the plan for 2023, is to run into my upper limit of estate planning problems. And I'll be in touch with you guys.
Yes. Well, and I got to say, Michael, and Dustin probably sees this, and Cindy as well, the issue comes when you're talking about that amount of money is control, because Dustin said irrevocable. Once it goes, it's not coming back, or you lose control of it. And so that's the planning and looking at everything is, if we put this over here, it becomes irrevocable, we're losing control. Who do you put in control of it? And can we, are we comfortable with that? So a lot to think through, but planning is key in all the conversations that we've talked about. Talking to all your advisors, focusing on you, planning is key.
Yeah, it sounds like thematically all of you would agree that if we can get in front of a specialist like yourselves or the folks in your industries, we're going to save a tremendous amount of money, time, probably heartache when it comes to the end of the year or a series of years. If we don't do the planning, it gets more expensive, and it's a lot more troubling.
Michael, can I address something that you and I talked about over the phone a couple of weeks ago? So my goal is to get the small business owners that I work with to the point where they need this type of planning that Donnie and Dustin can provide. So the common myth among business owners is that you want to pay the least amount of taxes possible. So what we see are business owners who buy with this mindset that they're reducing taxes by increasing deductions. But that's like using a 20% off coupon to buy something you don't need. So you're still spending the money, usually on things that go down in value, and you're not building wealth. So here's the deal. If you pay little to no tax, it's because you didn't make any money. So our goal in doing all of this planning that we've been talking about is for you to keep as much money in your pocket as possible through good bookkeeping, tax planning, and growing your business.
Cindy, absolutely brilliant advice. I think that if we are, as a small business, maximizing or solving for the least amount of taxes, we might be missing the main point, which should be essentially, how do we grow our revenue? How do we grow our income? And, taxes are a necessary part of having a greater income. Another way of saying what you said is that if you are paying a lot in taxes, it means you make a lot of money. So that's not a bad thing. Of course, we don't want to pay more than our legal obligation, and we do want to pay our legal obligation. But yeah, running your business to minimize your taxes is not as good a strategy as running your business to grow and increase your income. Ultimately,
Right.
more important way to do it. Cindy, really good advice. Donnie, thank you so much. Dustin, thank you so much. I think that everybody is interested in paying the right amount of taxes and not a penny more. And I think your advice, especially to seek out specialists, is right on. And I really appreciate the time.
Thank you.
Thank you.
Thank you for the opportunity.
Thank you all for joining us. If you would like more information about your tax needs, go to www.mysa.com/tax guide.